Friday, May 7, U.S. Bureau of Labor Statistics released its employment situation summary in April. Total non-farm payroll employment rose by 266,000 in April, whereas market expected 1 million. Why is there such a big difference? This is a graph showing the U.S. job offer rate. It is showing the highest level since statistics were compiled in 2001. That means companies are trying to hire a lot. And this shows that the future economic outlook is good. So, the market predicted that total non-farm payroll employment in April will be over 1 million. However, the actual figure was 266,000, which was a big deviation. Usually, when the employment index is bad, it is the case that the company offers only a little job offer. More than 95% would be this case. However, this month, even though the company is setting its job offer at an all-time high, the employment index was far below expectations. People are returning to work at a slow pace. In other words, it has become a dominant market for laborers. What is the reason? One of the reasons can be inferred from a graph showing changes in the savings rate in the United States. This is the savings rate from 1959 to the latest. After the pandemic, the first stimulus check was issued last year, and the savings rate increased sharply. Since then, it has decreased significantly, but the savings rate has increased significantly again as the second stimulus check was paid in early 2021. It's not that urgent for people to find a job because they have money in their accounts. It is expected that this savings rate will decrease and there will be no third stimulus check. Therefore, this employment index is expected to increase over time. And when schools are reopened, parents will be more free to find jobs. In other words, the reason the employment indicator came out bad this time is that the U.S. economy is not bad. The market is concerned about tapering. We will talk about this while looking at this graph. This graph shows the average weekly wage in the United States. The reason why average weekly wages rose sharply in 2020 because a lot of low-income workers left their jobs due to the pandemic. However, even though employment has recently recovered, the average weekly wage does not decline again. The average wage increase rate before the pandemic was about 3% per year. Comparing the wages just before the pandemic and now, it is a 10% increase. Also, companies are currently struggling with hiring. This is a factor in rising wages, and rising wages will lead to inflation. When inflation comes, the Fed will raise interest rates and begin tapering before that. This graph provides information on facility investment by U.S. companies. Looking at this graph, facility investment shows the highest in 2000, 2008, and 2012. From 2000 until now, the U.S. economy has grown by 50%. In other words, the product production was done offshore. However, recently, facility investment in the United States has passed its full peak and continues to rise. In other words, due to reshoring, facility investment in the U.S. is increasing a lot. The U.S. economy currently has a lot of demand, and facility investment is in full swing to meet the demand. This shows that the U.S. economy will continue to be good for the time being. This is good news for the stock market, but at the same time, it also has a burden. The rise in inflation and interest rate will come together. When will tapering begin? The Fed will give the signal enough time before starting tapering. In June of this year, the Fed will release a dot plot. At this point, it can be implied when tapering will begin. It can be inferred from mentioning the schedule for rate hikes. In addition, the Fed will report to the U.S. Congress in July, the Jackson Hole meeting in August, and the FOMC scheduled in September. The market sees the Jackson Hole meeting in August as the most important event. Today, we looked at total non-farm payroll employment released by the U.S. Bureau of Labor Statistics on May 7 and talked about its implications and future prospects. In short, the U.S. economy will continue to improve, which will lead to inflation and higher interest rates. And the Fed is going to shape the schedule for tapering. The stock market could fall under this influence. Energy stocks and financial stocks are more likely to be the leading stocks rather than growth stocks such as IT in the period where interest rates increase in this way. And if the schedule for tapering and rate hikes is specified, the stock market may decline, so it is necessary to gradually secure cash. That's it for today. Thanks for watching.